as far as I can see, according to the European Commission, Eurostat, there is really a clear indication that there is a jump. This private household private savings are skyrocketing, whereas the investment are going down. And it's really clear that the two things are related.
Yeah.
Why is that?
It's just very, very simple risk averseness and no demand. I mean, people cannot invest. There is nothing they can do. They stay at home, and above all, they are afraid. So they wait and they accumulate savings on their accounts. But of course, the saving statistics is everything, as well households. I mean, it depends how you look at it. Households, business, etc. And if you look at households alone, you see, I mean, the average of all the households. Of course, there are some which are still earning a lot of money, and there are others which don't have anything, which you don't see reflected in these accounts. Of course, all those in lower paid jobs, which have very limited savings, will not come out in these accounts, whereas people who are in government jobs or in large corporations which continue to work and get their salaries paid out as a normal way, spend much less. And of course, there you see the huge increase in savings.
Uh, Mr. Lannoo, it's Dr. Lannoo, it's clear, but at the same time, as far as I can see, as far as can one see, there is a problem when it comes to which segment of the population is able to save how many people in a country, say in an average country
Yeah.
of a Europe, average income country of a European Union, is among those who are saving, and how many people are among those who are not saving, who are losing money by that.
Exactly, but that will first of all differ from country to country. It will depend on, let's say, the kind of the what they call of, let's say, these statistics on the Gini coefficient. Let's say, what is the difference between the poor and the rich, and how big is this coefficient? And of course, countries where the coefficient is high, like in Belgium, let's say, have a low difference between the poorly and the rich, and others have a bigger difference. Let's say where the coefficient is low, have a bigger difference. And of course, there you will see probably, I mean, that the savings, like for example Spain, which is known to be in that case, the savings have not increased that much as they have, for example, in countries where the Gini coefficient is under control, which, for example, like Belgium, the Netherlands, or the Nordic countries.
Yeah, but if I look at, for instance, at the Nordic countries, some Nordic countries, especially the Dutch, we see on the ECB second quarter of last year, we see that there is a huge private debt, well beyond almost the 200% as an indicator. And this is much more a phenomenon of a Nordic countries, of a northern countries, and the Dutch are heading this group. So
I know,
how?
but let's say, of course, in the Dutch statistics, you have to see, let's say, that the Dutch have a mandatory system. I mean, you have to see in savings and how is national savings organized. Sometimes it's not organized, for example, to contribute to a pension system. In other countries, it is organized to contribute to a private pension system, like it is in the Netherlands. The savings statistics in the Netherlands include what is the mandatory savings for national pension system, which is not mandatory in other states, or where it's more part of this of kind of the state pension. In the Netherlands, you have the state pension, plus you have the private pension, which people is a mandatory saving for every contract for people to put a big part of their salary into the saving. And that makes the statistics to explode, which you have also to some degree, and we see it in the same statistics for Denmark and for Sweden. These are the countries, apart from the UK, but in Europe, which have a very well established pension system. And that's why also they have lots of savings in there. And that's why also they jump out in these statistics, because on the other hand, also these households do not invest like all the other European households, or they do not spend money like the other European households. But of course, their overall wealth is much higher than kind of Southern European households. And so their propensity to save is also much higher than in Southern European households.
But at the same time, as far as one can see, is also that the fact that how do you explain the debt? The debt is the debt comptabilized with taken in account with this pension scheme or why they
That's
have
the other thing which we don't see in the statistics. Of course, we look at private households savings. Who's helping us through this crisis? It's the states. So the states get much more indebted with an increase of easily 20%. Take Belgium, take Spain, take Italy, whereas the households are protected at the moment. But one day the households will have to pay the bill for what states are doing at the moment, because the states are basically all the citizens of a certain country. And so one day we will have or to pay more taxes, or they do it in another way, by which the government debt will have to be reduced. Because in many countries, by the way, the government debt is above, is above 100%, or is above sustainability levels. And like in the case of Italy, it's even considered to be, impossible to carry further. It was already impossible to carry further before this crisis. It will be even worse now.
and so what do you think it will happen in this case? Because you said it's impossible to carry further. Do you think that there will be a kind of bail-in, national bail-in, like Cyprus or something like that?
I mean, there have been already many different possibilities raised, but of course, the big issue in this crisis is that, of course, national debt is increasing, but who has increased also the debt to try to solve this crisis is the EU. And the EU, with the next generation EU, is going to the market itself. So the national debt data do not include, let's say, the EU's debt data. The EU until today had hardly any debt, but now with this big issuance in the market, we'll start to have some debt, which we will not see reflected in the national statistics. And by this, it reduces the burden on certainly countries which already had a high debt, and it doesn't increase it that much. And of course, if you were to speak to a public finance official, they will say, look, we'll look at this again in 3 to 4 years. The recovery can be very strong as soon as the COVID crisis is over. And then we will see, because of the very low interest rates, we will see the debt which countries have decline fairly rapidly. Because we are what we call in a positive snowball, in the sense that, since the interest rate which governments pay on debt is much lower than the inflation rate, there's a positive effect and a kind of an even accelerating effect on the decline of the debt.
In this scenario that you are describing now, in the case that this crisis will finish and that the world will be overwhelmed by a huge wave of optimism, and the household will start spending and working and so on and so forth. Do you think that the fact that now there is this huge amount of money, of liquidity that is blocked in the banks, and this liquidity will play a role one day uh, when everything will be over, and which kind of role could be played by this liquidity?
So many things can happen. Some people have already said there will be inflation, because what will this liquidity do? They will look for investment. We've seen it already in several European countries that the investments in real estate, private real estate, not the commercial real estate, has gone up. And because there's plenty of savings, what do people do? I mean, they invest probably in an additional investment in real estate. And so that may be initial signs of asset inflation, but overall inflation, which we will see, just because there will be more demand than there will be supply. Of course, this is not a problem yet. Let's say there's a kind of a supply shortage of demand, let's say, for plenty of goods, let's say, so there is a deflationary effect. But one day, let's say, when all of a sudden, let's say, this demand will be in full again, there could be an inflationary effect, just because there is so much liquidity all over, and the interest rates of the central banks are so low. Of course, the central banks will then start to react. But then, of course, if interest rates increase too massively, with large amounts of public debt in the hands of the state, that will create problems for the states to pay interest rate on their debt.
Is a problem, according to you, is this, is this amount of money that are in the banks now could become a systemic problem for the banking system or for the economy of a euro area? Or is just an imbalance related to a lack of investment in venture capital that is a traditional and physiological problem of a European economy?
Indeed, what we've seen in the United States over the past year as compared to Europe is that in the US stock markets have gone up enormously, certainly for those stocks which were adapted to this crisis. We haven't seen the same in Europe. In Europe, the stock, the indexes of the main stock markets were basically flat over the past year, so have recovered from the decline in March. They are probably at the same level as they were in the beginning of 2020, whereas in the US, they have gone up a lot. You see the big difference between the United States and Europe. Europe, which keeps money on savings accounts with banks, whereas in the United States, people have much more the ability to, or the habit to invest. But I don't think there is then related to that a problem, let's say, with the banking system. On the contrary, if the banks have many savings, the banks do the investments in fixed assets, etc., which households do not do. Of course, and the banks reckon for households also, certain fees, let's say, for all these things. So banks earn money on our savings.
That's my last question. So in this case, the comparison you made between the European economy and the U.S. economy. What you are saying basically is that the U.S. Private savers, households, took advantage of this economic lockdown, economic lockdown. They didn't spend money, they didn't go abroad, to use this money and to orient this money towards venture capital, whereas the European investors, European savers, didn't do that, just froze this money in their bank accounts.
European investors invested through funds, which probably have invested in venture capital, invested directly in the capital market. One of the phenomena which we've seen over the last year in the United States is that many retail investors have driven up stocks, like, for example, Tesla, to a large degree, something which, was not seen to the same degree before, but probably people were sitting at home, had much more time, they didn't have to commute, so they were also investing on the markets, and they saw these effects. Something which is not, to the same degree happening in Europe. If you compare Europe to the United States, Europe has more than the double in savings accounts and banks, let's say, than the United States, whereas the US has, I think, 3 times as much in investment funds invested than Europeans have. But in the meantime, what you see, let's say, they have gotten the returns, they've got more savings, a more kind of available assets for the households, whereas in Europe, let's say, they haven't performed that well. They are simply, giving a return of 0%, the money which is saved on banking accounts. So what do you see overall after a year, let's say, is that on average, US households have done better than American households. Of course, making abstraction of the difference between the poor and the rich. So we've also heard, let's say, that richer households have become even richer in the United States. Of course, but we don't speak about poorer households.
So why is Wall Street skyrocketing, whereas the European stock exchange are less performing in this situation?
I think the main reason is this appetite for risk, and that Europeans are very averse, much more averse to risk than Americans, but that the Americans are much more used. If they see an opportunity, they go to the market and they go into this. Of course, the system is also...
Sorry, but you said before that in America, it's the private who do that, who usually does that, whereas in Europe is the bank. So what's the difference? Anyway, the bank is doing what the private citizens are not doing, what the private...
Exactly, but the banks should do it. In certain countries, it's organized that, like I mentioned, the Netherlands, that if there is a pension system by which invest your savings, then it's happening. But in other countries, most European countries, this is not organized like this, and the money simply sits on the account of the bank. And if the saver asks the bank, look, I want to invest my money, the bank will do it. But the cost for these investments in Europe is also at least 10 times higher than it is in the United States, because the charge on an investment fund in the US is about 0.2%. The cost on investment fund in Europe is 2%. So that's why people also are not investing in funds in Europe, because the cost to do this is too high. And if they say if it's 2%, then they simply say, look, I better keep my money on the account. Whereas in the US, if you invest in a Vanguard account, and you can see the cost in, for example, every newspaper in the United States, it's 0.2%. It's a very competitive market. It's a real single market. In Europe, we have a fragmented market with many different providers, 10 times more funds than in the United States, but a very low size and very high costs.